Liquidity just went solid. That's when the credit risk manager's monitor blinked into black. It wasn't a blackout at all, more like the figures simply disappeared. The Fed's fresh flow of funds report had just hit the wires, and the $2.5 trillion of corporate debt cluttering his desk was no longer just a spreadsheet entry. It felt like a mountain, and that mountain was trembling. I'm Gregory Hale. For 20 years, I've been chasing the quiet tempests in corporate credit, those storms that stay off the news until they're already over the hill. That's exactly what the headlines overlooked. In this video, you'll watch that $2.5 trillion debt mountain split wide open. You'll meet mid-size firms scrambling for breath as their credit lines evaporated overnight. And you'll see why a single misstep could set off the recession everyone's been dreading. The Fed's Q4 2023 flow of funds report backs it up. Total U.S. corporate credit topped $2.5 trillion, the biggest figure ever recorded. That's more than just a number. It's a time bomb lodged in the balance sheets of thousands of firms you've never heard of, and a few you probably know. But here's the part the Fed left out of the headline. That mountain isn't spread evenly. It's concentrated, and the cracks aren't merely appearing, they're spreading. A credit line that was $50 million last week has been whittled down to $5 million. A supplier who could borrow freely on Monday sees a bank's pending review email land in their inbox by Tuesday. Liquidity didn't just freeze, it vanished. Consider a mid-size industrial maker out in Ohio. In December, their revolving credit line sat at $150 million. By January, the bank had cut it down to $30 million. They were given 48 hours to scrape together $120 million in cash or go under. That wasn't an outlier. It was a pattern. SEC filings, as sifted by S&P Global, show high-yield corporate bond defaults climbing to 4.2% in 2023, up from 2.7% the year before. That's the highest default rate we've seen since the 2008 crisis, and it's speeding up. The warning signs were flashing red, but the markets hadn't panicked yet, because most of the damage was lurking in the middle, in the mid-size firms, the backbone of the economy, the ones that don't make the S&P 500 yet employ millions. Then February 15, 2024 arrived. Bloomberg put it bluntly, credit markets brace for shock as defaults rise. Analysts cautioned that a tightening credit market could push dozens of mid-size firms into cash flow distress within weeks of a major default wave. That wave didn't need a storm. It only needed a spark. And the spark ignited in an unexpected spot. A mid-tier regional bank in Texas, buckling under commercial real estate losses. When it fell, the ripple didn't stay on Wall Street, it seeped into the veins of everyday business. Overnight, credit committees nationwide switched their tune. We're pausing all new commitments. No extensions. Full re-underwriting required. The message was crystal clear. The spigot was shut. For mid-size firms, that boiled down to one thing: survival mode. A week after the Texas bank's collapse, a supply chain logistics outfit in Pennsylvania, sitting on $600 million of revolving credit, got a call from its lender. We're cutting your revolver to $120 million, effective immediately. That firm, like thousands of others, had built its whole business on the assumption that credit would always be there. Now it was. A New York Times investigation logged dozens of similar cases in March 2024. Suppliers with $500 million plus in revolving lines found themselves staring at frozen gates. The dominoes were falling, and no one could tell where the chain would stop. The IMF said it plainly in its 2024 World Economic Outlook. Global corporate debt now exceeds $30 trillion. And a swift correction in credit conditions would magnify sovereign and private sector vulnerabilities. That wasn't a forecast. It was a warning. Because here's the truth no one's saying out loud. That $2.5 trillion in corporate debt isn't just a number. It's a house of cards built on borrowed time. And when the air leaks from that balloon, the fall isn't just quick, it's systemic. Credit risk managers like the one in our opening scene, they don't panic easily. They've seen cycles before. But this time, something felt different. The numbers weren't just high, they were unsustainable. The liquidity wasn't just tight, it was vanishing. And the mid-size firms at the heart of the economy, they were the first to feel the squeeze. This is the moment the credit risk manager's screen went dark. Not from a power outage, but from the realization that the whole system was rigged to fail and the fuse was already lit. And the worst part? He knew exactly what would happen next, because when mid-size firms can't breathe, the whole economy suffocates with them. The night a credit risk manager locked eyes with the Fed's freshly dropped flow of funds report, his monitor bathed in $2.5 trillion of corporate debt, the highest pile ever logged. He let out a quiet, "Well, here we go." That number isn't just hype. It's the steel skeleton of America's credit machine. The Federal Reserve's Q4 2023 snapshot puts total outstanding corporate credit at a tick above $2.5 trillion, a mark no one's seen before. Source: Federal Reserve, Flow of Funds 2024. Still, the big number hides a deeper ache. Global corporate debt just crossed $30 trillion per the IMF's latest World Economic Outlook. Source: IMF, WEO 2024. When a market that size starts to clench up, the tremors don't stay on Wall Street. Junk-rated borrowers are already feeling the pinch. The SEC's S&P Global deep dive on 2023 high-yield defaults shows the default rate jumping to 4.2%, up from 2.7% a year earlier. Source: SEC Edgar. Each percentage point equals piles of missed coupon payments, and every default chips away at the nerve of lenders still holding the rest of the paper. Then there's the middle tier, the firms that aren't tiny mom-and-pop shops, but also aren't too big to fail. Their lifelines are often revolving credit lines that sit just north of $500 million, a line the New York Times flagged in its deep dive on supply chain financing. Source: NYT, March 1, 2024. When those taps shut off, refinancing maturing debt becomes a pipe dream. Last month, a regional parts wholesaler, a mid-tier outfit with a revolver well above $500 million, hit the wall on a senior note maturity. The outfit had counted on rolling the debt into fresh credit, but banks, already skittish from junk defaults jumping 1.5 points in a year, said no. The distributor burned through cash to plug the hole, slashed inventory buys, and ended up missing a key order from a Detroit automaker. Out on the Pacific Northwest coast, a niche machinery builder faced the same refinancing wall. Its senior unsecured bond, priced 2 years back, came due this quarter. Its revolver, also north of $500 million, was frozen solid as lenders tightened covenants in lockstep with the broader credit chill. Without fresh money, the firm shelved a $30 million expansion and let go a quarter of its staff. The third story is about a cloud outfit that exploded during the pandemic. Its balance sheet leaned hard on a revolver that hovered just above the $500 million line. When renewal season rolled around, the outfit found a credit downgrade had just hit its name, a move driven by the rising tide of junk defaults. The downgrade tripped covenants, and the bank walked away from rolling the debt. All three, same script. They're mid-size, they rely on big revolvers, and they're staring into a credit market that's tightening faster than most forecasters predicted. Bloomberg's February 15, 2024 brief flatout warned that a credit squeeze could push dozens of mid-size companies into cash flow crunch within weeks of a default avalanche. Source: Bloomberg, 2024. That warning isn't hypothetical anymore. These three cases are the first dominoes. So why are credit lines vanishing so fast? First, lenders just upped their risk dials after junk defaults hit 4.2%, a full 1.5-point jump versus last year. Source: SEC Edgar. When defaults climb, banks yank underwriting standards and beef up capital cushions, leaving less room for any new risk. Second, the big picture is making it worse. The IMF flags that a sudden credit freeze magnifies risks for both governments and businesses. Source: IMF. When governments, US see their own debt load swell, regulators get twitchy about handing out fresh private sector loans. Third, the supply chain credit crunch the Times spotlighted shows even firms with big revolvers are getting squeezed. Those once cozy credit lines now come with tighter usage caps and wider interest spreads. Source: NYT. The credit risk manager's face says it all. This isn't just a number, it's a chain reaction waiting to happen. If dozens of outfits like these three can't refinance, the ripple hits suppliers, buyers, and workers across the board. Industry watchers, quoted by Bloomberg, point to three gears turning at once: junk defaults spiking, liquidity shrinking, and regulators leaning harder. Source: Bloomberg. Together they're cranking out a credit squeeze that's both quicker and deeper than the one that followed 2008. To put the math in perspective, think about that $2.5 trillion corporate credit pool. Even a 1% pullback means $25 billion that has to come from somewhere else or get eaten by cash reserves. For mid-size firms who run on thin margins and tiny cash cushions, that hole is game over. This isn't just about spreadsheets. It's about real companies learning the hard way that credit can flip hostile overnight. The 3 case studies show how one broken revolver can snowball into layoffs, stalled projects, and lost contracts. As we look ahead, the big question is simple. How many more firms will bang into that same wall before the storm breaks? The answer rides on whether lenders reopen the spigot, whether borrowers can rejigger their debt, and whether policymakers step in with stopgap cash. Next up, we'll size up the policy moves coming down the pike and sit down with the execs who are scrambling to keep their doors open. Stay with us. That night, the manager cracked open the spreadsheet, and suddenly the numbers stopped feeling abstract. A single default, a mid-sized parts supplier out in the Midwest, had already set off a cascade of payment failures, rippling through dozens of downstream manufacturers. The sheet lit up red, each cell flashing a warning flag for a vendor's overdue invoice, a logistics firm's missing freight payment, and a retailer's stalled order. It was the first visible crack in a credit wall that, until then, had seemed immovable. He traced the chain backward. The default forced the supplier's bank to freeze its revolving credit line. That line, per a recent New York Times investigation, was the lifeline for supply chain firms with $500 million plus in revolving credit lines rep. Source: The New York Times. With the line frozen, the supplier couldn't meet its own obligations to component makers. Those makers, in turn, halted shipments to assemblers that relied on just-in-time inventory. Within days, the disruption spread from that single plant to 3 major automotive factories, each reporting a shortfall that threatened a $200 million production run. The pattern was unmistakable. One credit failure turned into a domino, each piece toppling the next. A Bloomberg analysis warned that a tightening credit market could force dozens of mid-size companies into cash flow distress within weeks of a major default wave. Source: Bloomberg. The manager's own firm, a mid-size lender that had prided itself on aggressive underwriting, suddenly saw its exposure balloon. Its senior loan officer called an emergency meeting, announcing a credit call-off that would suspend all new financing pending a full risk review. The call-off wasn't just a procedural step. It was a signal that the firm's own liquidity was under threat. Across the nation, the Federal Reserve's latest flow of funds report showed corporate credit at a historic high, roughly $2.5 trillion in outstanding debt. Source: Federal Reserve. That figure, while impressive, masked a growing fragility. High-yield bonds, the sector most vulnerable to cash flow shocks, had already seen default rates climb to 4.2% in 2023, up from 2.7% the year before. Source: SEC Edgar. The rise in defaults wasn't an isolated statistic. It was the early tremor of a broader credit contraction. Economists at the International Monetary Fund warned that a rapid correction in credit conditions would amplify sovereign and private sector vulnerabilities. Source: IMF. In other words, the tightening of corporate credit markets could spill over into government finances, eroding tax revenues just as public debt levels were already straining fiscal balances. The manager felt the weight of that projection. If his firm's clients could no longer borrow, orders would dry up, revenues would slump, and the ripple would reach the Treasury's budget forecasts. The personal stakes sharpened. The manager recalled the night his own CFO walked into his office, eyes fixed on the same spreadsheet, and said, "We have to prepare for a credit downgrade." The phrase was a prelude to a formal rating agency review that could reclassify the firm's debt from investment grade to junk. Such a downgrade would raise borrowing costs, force the firm to sell assets at fire sale prices, and potentially trigger covenant breaches on existing loans. The manager's pulse quickened as he realized the default he had been monitoring was not a distant scenario. It was the catalyst for his own firm's crisis. Outside the office, the macro picture was already shifting. Supply chain firms with massive revolving credit lines were reporting strained cash positions, as the NY Times story detailed. Credit analysts, quoted by Bloomberg, warned that the next wave of defaults could arrive within weeks, not months. The manager's discovery was therefore not an isolated incident, but the opening act of a national credit crunch. He stared at the data, the red cells now forming a pattern that resembled a spreading fire. The heat map showed that sectors most exposed to the credit freeze, automotive, aerospace, and electronics, contributed over $300 billion in GDP. A contraction in those sectors alone could shave a noticeable percentage off the nation's growth rate, nudging the economy toward recession. The IMF's warning about amplified vulnerabilities became a concrete forecast. A rapid correction in credit conditions would likely depress consumer spending, reduce business investment, and increase unemployment. The manager's phone buzzed. A colleague from the risk desk sent a terse message. Liquidity freeze is a leading indicator of recession. No need for further analysis. The data spoke for itself. The manager understood that the term leading indicator was not academic jargon, but a real-time warning sign that the broader economy was about to stall. In the silence that followed, the manager made a decision. He would raise the alarm internally, push for immediate tightening of credit standards, and advise the board to prepare a contingency plan. The cost would be short-term profit loss, but the alternative, a blind walk into a credit abyss, was far worse. His own firm's fate, the health of mid-sized suppliers, and the stability of the national economy now hinged on how quickly the warning could be turned into action. The ripple had begun, and the manager's pale face reflected the gravity of what lay ahead. A credit storm that could reshape the corporate landscape, strain sovereign finances, and usher in an economic downturn that many had only feared in academic textbooks. The next chapters would test whether the market could adapt or whether the collapse would become a full-blown recession. As the credit risk manager delved into the $2.5 trillion debt landscape, a disturbing picture emerged. When the credit risk manager started digging into the $2.5 trillion debt maze, a pretty unsettling picture popped up. The total outstanding corporate credit in the United States, as reported by the Federal Reserve's Flow of Funds Report, Q4 2023, had reached an all-time high of approximately $2.5 trillion, source. According to the Federal Reserve's Flow of Funds Report for Q4 2023, total outstanding corporate credit in the U.S. hit a record high of roughly $2.5 trillion, source. This staggering figure, combined with the rising high-yield corporate bond defaults, which increased to 4.2% in 2023 from 2.7% in 2022, source, signaled a potentially catastrophic credit crunch. That eye-watering number, together with high-yield corporate bond defaults climbing to 4.2% in 2023 from 2.7% the year before, source, rang alarm bells for a potentially disastrous credit squeeze. The implications of this liquidity squeeze could be far-reaching, reshaping the financing landscape for thousands of businesses. What this liquidity pinch could mean? It may be far-reaching, reshaping how thousands of firms get their financing. Analysts warn that a tightening credit market could force dozens of mid-sized companies into cash flow distress within weeks of a major default wave. Source. Analysts are already warning that a tighter credit market might shove dozens of mid-sized firms into cash flow trouble just weeks after a big wave of defaults hits. Source. This would not only affect the companies themselves, but also have a ripple effect on the entire economy. That wouldn't just bite the companies, it would send ripples through the whole economy. To mitigate this risk, leaders can take proactive steps. So, to blunt this risk, leaders ought to act proactively. They must closely monitor their credit lines, manage cash flow, and diversify their funding sources. They need to keep a tight eye on credit lines, steer cash flow carefully, and spread out their funding sources. The IMF's World Economic Outlook 2024 highlights the importance of being prepared, stating that global corporate debt now exceeds $30 trillion, and a rapid correction in credit conditions would amplify sovereign and private sector vulnerabilities. Source. The IMF's World Economic Outlook 2024 stresses staying ready, noting that global corporate debt now tops $30 trillion, and a swift shift in credit conditions would magnify both sovereign and private sector weak spots. Source. The New York Times Investigative Report, Mar 1, 2024, sheds light on the supply chain firms struggling to cope with the credit crunch, with those having $500 million, plus in revolving credit lines being particularly vulnerable. Source: a New York Times investigation, Mar 1, 2024, shines a light on supply chain firms wrestling with the credit crunch, especially those whose revolving credit lines top $500 million. Source: it is crucial for businesses to stay ahead of the curve and adapt to the changing credit landscape. Bottom line: businesses have to stay ahead of the curve and adapt as the credit landscape shifts. In conclusion, the current credit risk landscape demands attention and action. To wrap it up, today's credit risk picture really calls for both attention and action. We urge viewers to stay informed and take proactive steps to mitigate the risks associated with the credit crunch. We're urging you, our viewers, to stay in the know and take proactive moves to curb the risks tied to this credit crunch. Subscribe to our channel for the latest updates, share this video with your network, and stay ahead of the next credit shock. Hit subscribe for the latest updates, pass this video along to your network, and stay ahead of the next credit shock. The time to act is now, and together we can navigate the challenges posed by the credit crunch and build a more resilient economic future. The clock's ticking, now's the moment to act, and together we can steer through the credit crunch challenges and build a sturdier economic future.